Hello, welcome to a new Ship Angel segment on market insights. My name is Graham Parker, and I'm joined by my colleague Andrew Bourget. Good morning to you.
Morning, Graham. How are you?
Good, and you?
Doing all right. Choppy waters.
Choppy waters. Lots to talk through today. Tariffs, port fees, record blank sailings. Let's kick it off maybe and talk about tariffs. I think that's front and center right now. Everybody is kind of in the thick of it, especially on the China import side of things.
Sounds good to me. One of the things that comes to mind for me when we start talking about tariffs is at the end of the day, a tariff is a geopolitical global negotiation of sorts. And how do you can't plan long term. When you don't know what the rules of the road are long term, it's hard for you to plan. But you have experience doing this. You've worked as an NVOCC in Europe for many, many years, and you weren't a Kuehne+Nagel, you were a startup, if you will. How do you see customers navigating sort of in this scenario where they can't plan long term or they don't feel like they can?
Yeah, I think it's incredibly difficult. The I've never seen a situation to kind of move as quickly and be as fluid as we see now in the tariffs. Um, and we, as you know, we're talking to customers all day, every day, and the stories are just astounding. Customers that have seen tariffs rise up to the triple digit figures that they're in right now. But I guess a kind of a good and to talk about would be one customer, one big name, one brand customer who has significant manufacturing in Vietnam that is a couple of years into a journey of moving it to Mexico. Convened a meeting a few weeks ago and said, "Hey, why don't we get a team to Vietnam?" And this is obviously at a time where the Vietnam tariffs were also very high, and they had a really excellent plan that we took a look at that basically was bringing Vietnamese manufacturing down to near zero incredibly quickly. And at the same time, then they were going to send another team to Mexico to really kind of ramp up the footprint that they had started to put on the ground a few years back in the middle of COVID. And it looked like an excellent plan, ramp down on Vietnam and ramp up on nearshoring in Mexico. It was always going to be challenging, but I think, a lot of people internally and externally agreed it was a great plan. And just as they were about to kind of green light it and execute it, somebody says, "Let's take a pause." And within the pause period of like 48 hours, Vietnam's tariff levels had changed. I think the moral of the story here is if you had gone and done something, it would have been a mistake. So sitting on your hands was kind of the way to go. So it's incredibly difficult to navigate.
Sometimes no action is better than the wrong action.
Exactly, and that's what makes it so difficult because we all know how incredibly diverse and difficult global supply chains are in 2025. But this situation is just so fluid; it's moving so quickly. It's incredibly difficult to plan ahead, and it's affecting trade. I mean, obviously, particularly in China, we hear on the ground all of the time that the drop off in bookings is absolutely incredible. We saw significant double digit numbers late March going into April, and now you hear numbers of 40, 50, 60% drop off in bookings.
I think what is telling too is it's not just bookings to the US have dropped off. I think there's some stats that we talked about where the bookings to the United States was 64%, I think was the number that we saw. But if you look at it on a global basis, the global percentage of bookings that are down are still pretty high, almost 50%. And so it's not just the TP. The TP is, one of the three most important trades globally, but it's not just the US. It seems to be a global reduction in cargo moving.
Yeah, it's incredibly widespread. And if you think about it, imagine if you take the TP shippers for a moment, coming to the end of contract negotiations, coming to the end of kind of getting another contract done for another year. Specifically, if you're doing a lot of your sourcing and shipping from China, and all of a sudden you need to move, possibly pause those contracts, hold off on signing them, which is causes all utter chaos already. And then at the same time, you probably have to look at a whole bunch of new areas for spot pricing, which is super difficult. It's super difficult for the shippers. It's incredibly difficult for the carriers as well. You could have somebody who is a very, very seasoned shipper from multiple ports in China, and now all of a sudden they have to say, okay, let's pause those contracts, and can you give me spot rates on these six new areas that could take over from China? And they could be parts of Southeast Asia, it could be North Africa, it could be Indian subcontinent, it could be a number of different areas. But it's incredibly challenging because you're going from a world of, okay, I know every year I've got X amount of origins and Y amount of destinations. They're pretty consistent most years. Now that's all on pause, and I've got to go and find out the intricacies of getting rates from all of these brand new areas, and they're going to be on a spot basis. How do I get the spot rates? How do I collate them? How do I know how competitive they are? When do I convert a spot rate into my contract? It's incredibly difficult for shippers right now.
Do you think traditional direct carrier relationships are diverging to where companies now have to have NVOs? And so we've seen it with some of our customer base, their strategies on how they manage their rates and their allocations and how they move cargo is changing. Do you think customers are going away from that? I work with three carriers direct and I have a booking agent. It sounds like it's more, I need carriers direct, but I also need that variable piece that an NVO can provide.
Yeah, definitely. I think, we've seen a strategy from a number of carriers over the last 5 to 10 years of moving towards kind of direct BCOs. And, some carriers obviously have utilized a lot of digital tools. A lot of them have expanded their own freight forwarding capabilities. But, I think coming out of COVID, we saw a lot of shippers wanting to have, to your point, Andrew, a lot more of a diverse portfolio, a larger NVOCC group, a larger VOCC group. And again, it just talks to the complexities of again, this is obviously very, very commodity specific. But if you are being forced to look outside China, depending on your product, you're looking at Southeast Asia. Again, depending on other products, you might be looking at depending how it's classified by each carrier loop, Indian subcontinent or areas within kind of Bangladesh, Cambodia, India, parts of Eastern Europe, parts of North Africa, Latin America, Central America. It's incredibly diverse, and not all carriers are suitable to all of those extra areas. So to your point, like the NVOs then really come into their own and can take a whole kind of plethora of different spot requests and serve them regardless of where they are in the world. So I think the good NVOs will really, really be able to help the shippers right now. And I think at the same time the carriers are also drastically trying to look at their own loops and trying to see if the situation in China was to continue for let's call it the medium term. I don't even know what that means exactly. Is that weeks or months? Who knows? But let's call it the medium term. What do you do with the loops? Are you expanding into Vietnam and other big Southeast Asia areas with some of these vessels? Are obviously a lot of the top 10 ports are in China, Shanghai, Ningbo, Shenzhen. Can all of those giant ships call at all of those terminals in Cat Lai and the other ones in Vietnam and Thailand? There's just so much going on from a shipping line perspective as well. Like where do I divert those ships and loops? How do I change some of those loops to make up for the drastic downturn in China?
Interesting. It's flexibility. And we get into the discussion of NVOCCs give you that flexibility to I'm going to start buying, 2 pallets a week from Cambodia, that eventually it becomes 2 containers a week. And you can't always plan for that growth now, but the NVOs give you that flexibility. Conversely, and also very similarly, the carriers are starting to generate some flexibility in where they deploy their assets. In, they're no longer maybe shipping on the Trans-Pacific. I think we saw some of the blank sailings are starting to skyrocket. As you can imagine, in a world where bookings are down 50, 60%, so is the sort of where we put our assets. Kind of like you said, they're messing with strings, they're moving stuff around. And so you start to talk about that environment. Now the carriers have a ability to be somewhat flexible because now they might have an extra ship or two. And historically, the last sort of year or so, there hasn't been a lot of extra capacity in the shipping market. I think when we look at some stats from Alphaliner, they put the idle fleet at around 1%, meaning 1% of the 3+ million TEUs in circulation is actually able to be bought on the charter market. You add all that up, blank sailings, flexibility, it could be a situation where, bookings are down, but places like Vietnam, Cambodia, Thailand, there could be a large increase in cargo moving out of there. And so that flexibility, maybe the carriers can somewhat plug and play some of that extra tonnage they now have access to.
Yeah, absolutely. And the blank sailing numbers are really staggering, right? Like when you compare them to COVID, even it's even a more bleak picture right now.
I think it was in some of the blank sailings, it's almost double. The blank sailings are down almost double what they were during COVID. And so I think that number was about 50 blank sailings. I think we're trending closer to 80 to 90 blank sailings at this point. And so you take a lot of that capacity out, you have a lot of blank sailings, which, the hope is one blank sailing is a data point. Two blanks on the same service in 2 weeks, now it's a trend. It'd be very interesting to see how those blanks trend, not just 1 week, but over the course of maybe multiple weeks and months.
Yeah, it's quite staggering when you look at, like, I mean, we unfortunately we can all remember that COVID period when and it wasn't just, I mean, the world stopped. I mean, in Chinese terms, there was famous pictures of the streets of Shanghai totally empty. And at that time, to think that you have 50, 55 blank sailings, and as you said, this month we're already trending above 80, which kind of talks to the sheer scope of this. And we're still in the very early days, and it's still a very fluid situation. But that is a pretty succinct data point, and it's quite scary. I think from a carrier's perspective, it's also, as you said, on the idle capacity, Andrew, it's very, very low. But also, the carriers have changed so much over the years. I mean, obviously record profits during COVID, but also pretty significant costs now with the Red Sea situation. Literally 2 or 3 days ago, we saw another Houthi attack on a French vessel. So that situation continues. We heard from various carriers at TPM that to reverse the Red Sea situation is a kind of a 6-month project. So we're about to go into the 5th month of the year with no end in sight. So it's hard to see us, in a best case scenario, we end 2025 coming out of the Red Sea scenario. But we've got the backdrop of the Red Sea scenario with prolonged transit times around the Cape of Good Hope, resulting in pretty significant increase in fuel. Although the price of oil is down, but it's still much more expensive to go that route. And the carriers had all of the Asia Europe contracts put away for 2025. A lot of the Transpac ones almost done. I think it'll be very interesting to watch and see which version of the carriers do we get. Do we get the kind of older fashioned ones where rates kind of drop right back, or have we kind of passed the point of no return where rates will never go back down to that level? And even though we've seen a decline, they're still at a kind of almost break even or post break even stage. Contracts at a point where they're not losing money. It'll be very interesting to see from a carrier perspective. It feels like they've been like heads down the last few weeks trying to get some of these kind of rotations right in their head. Where do they change loops? Where can they maintain blank sailings? Where can they reposition ships? But it'll be very interesting to see that kind of carrier um, outlook and how that kind of filters into the market.
Yeah, what's super interesting about that is the carriers are trying to just like the BCOs, the importers, the exporters who can't plan long term. Carriers have to plan long term. They have to know what's going to sail next week, in 6 weeks, in 7 weeks. They have a lot of assets in ports, calls, and they need to set up a lot of stuff, even as simple as we need to make sure we have a spare screw for that machine that needs to be replaced when it gets to New York City. Well, if it's not going to get to New York City, what do you do about that? There's a lot of work being done behind the scenes to keep these assets floating. Pun intended, completely. It's going to be interesting, how do they react? And right now they're canceling sailings. They're doing something. A lot of importers, like we just said, are doing nothing. Maybe is the best answer and waiting. They can't wait, and it'd be interesting. The longer this goes, the more action they have to make, and we've seen rate decline happen. The spot market, as you mentioned, relatively speaking, is into the U.S. East Coast and the U.S. West Coast is close to break even. Carriers are probably making a little bit of money on one hand and spending a little bit on the other, and so it would be very interesting in this current environment, short term, if tariffs change tomorrow, I think you'll see a whiplash, an avalanche, a tsunami of cargo being moved out of China. But right now, it's a very cumbersome environment for everyone. It's tough to plan short term, very tough to plan long term right now.
Yeah, definitely. And again, from a carrier perspective, like first order of magnitude is sorting out these incredibly costly assets, these floating cities, big ships. But when we get to the stage of thinking about um, smaller costs, but also considerable costs, where containers at ports were looking to be sent back to the factory and destuffed rather than shipped, or we don't know how many cases we'll see of containers arriving at U.S. ports that the consignee doesn't want to receive and wants sent back, or how much of an impact is that going to have? Because we know, talking to customers, just looking at the actual cost of goods with the tariffs, how much of a insurmountable position they're in. They don't know how much they can pass on to the customer. It is there's just like so many layers to the problem. It's one of those ones that's like 5, 10 issues deep. You've got to think through all of these from a shipping lines perspective, as we say, but also from a BCO perspective. And it's incredibly difficult, and it's heartbreaking to see some of the stories on social media, particularly of smaller brands who feel it much faster, that are kind of over indexed on China. We see and we hear a lot too about Vietnam seems to be one of the ones where manufacturing is moving towards, but also it's very difficult if you were a small or medium brand to actually get manufacturing capacity now in those countries, because the big companies are just moving and flexing their muscles. So it's incredibly difficult to watch some of the smaller brands try and find their feet, trying to understand what they do. Even if they can find a factory, it's very difficult for them to get capacity at any sort of a time frame, i.e., the next like 50 to 100 days. It's yeah, it's super difficult.
Question. This is a great question for you, Graham. You've lived in technology meets supply, the intersection of technology and supply chain. You've really lived in it for many years. From a technology standpoint, how does Ship Angel specifically, but how does technology help these importers who are facing increased cost, increased pressure from their C-suite? They're asking them broad questions, tell me what to do. And in cases they don't have the answers, how does supply chain professionals utilize technology to help them get through this storm?
Yeah, great question. And I think there's probably like a whole cohort of tools that are really important right now. Like right, right down to sourcing tools. Like if I'm sourcing from China, where are my backup options? How can I get access to options that have been pre-vetted, that I can get, talking to and see what type of capacity they have available. I think also expertise around customs technology is becoming more important. Understanding how these effects are taking shape. If I'm an importer, how does it affect my potential bond? I think having software there, and for us, and I think on the Ship Angel side, it's really interesting. As I've seen technology kind of proliferate throughout supply chain over the last decade plus, dealing with numbers is probably the hardest part. If you're reading a bill of lading, or any other kind of shipping document, that is majority words, uh, AI has got a really great grasp of taking in those documents and understanding and giving you advice and output. But when it comes to numbers, and we see this with our own AI machine learning technology, it's very difficult for AI to understand complex shipping rates and a couple of thousand lines that says when you have this delivery, you have to note that the driver needs this fee because it's going over an extra toll because it's Wednesday. There's so much to understand on the number side, and I think for us in Ship Angel, trying to help the customers understand how their rates are changing, giving them an ability to get kind of access to a significant amount of spot rates quickly through our technology and vendor connect capabilities is really important, because again, understanding numbers, if you were taking, it could be tariffs, it could be trying to calculate product costs. It's not as simple with technology when you're dealing with numbers in supply chain as it is when you're dealing with a bunch of text. It's very easy to push text into ChatGPT and it can basically tell you anything. If you push a bunch of shipping numbers into ChatGPT, you probably won't come out with a coherent or kind of robust answer. So kind of working with partners, I think that can help you, is really important, and also something that we're very passionate about, and is becoming really important as well with customers that new customers are working with right now is going live quickly in 3, 4, 5 days is really important. If you do need help, you do need a solution. You do not have the bandwidth capacity to have a software implementation for weeks or months. You need tools that can just plug in and help immediately. I don't think anybody has that kind of capacity, and um, I think it's also like we've just moved from crisis to crisis since COVID. We went from COVID to the Ukraine war to the Red Sea, now to tariffs. And when I think about numbers and complicated rates and tariff numbers and commodity codes and every other sort of number we have to deal with, we unfortunately have another one on the horizon in terms of port fees.
Yeah, that one's interesting, and it's funny. The If you take the pulse of the industry the last 36 hours, it's more of a sigh relief. But if you look at it from an importer perspective, there's still some tangible costs that importers are going to have to at least be aware of. And what's interesting is our perspective a bit here is that the exporters from the United States probably won't pay these fees. The importers are paying higher rates and in some cases triple the price, but the export rates usually are not profitable. They're more just trying to feed containers back to Asia. And so it's going to be interesting, how does that dynamic relate to increased costs? And to get into the numbers, the specific cost increase for a Chinese operator with a Chinese vessel is $230 a TEU starting this year in just a handful of months. When we're sipping pumpkin spice lattes, the prices are going to be going up, $200-400 a box, depending on what you ship. And those are hard to swallow as we're in an environment where rates are already very low. And so we have very low rates. We have not a lot of cargo moving. If these tariffs continue and we start talking about these port fees in October, shippers who utilize contracts for these Chinese carriers, they are going to be looking at a potential cost disadvantage versus some of the other providers.
Wow, it's hard to even think about it, but from October you could have a whole bunch of new surcharges, which in itself is actually kind of a mathematical formula because it's going to be different fees for different ports for different carriers, and how each carrier will implement it remains to be seen. It's just increases the complexity to like just another, you know, as if we weren't already at like 11 out of 10 complexity. We're now at kind of 12 out of 10. Wow. And there are some carriers that are more affected than others.
hmm And so, just looking at the numbers, from my perspective here, we're looking at a carrier like Zim, who is not in the top five in terms of the volume they move, but based on their exposure to the Chinese toll, if you will, for utilizing Chinese ships, something like 50% of their port calls into the U.S. are now exposed to $230 a TEU come October. That's a significant price.
Wow. And if it's October, it's still a few months away. Do you see any kind of opportunity to mitigate that, like, you know, correcting out your Chinese ships out of vessels that call the US and move them onto other trade lanes?
Yeah, and so I think some of the data points to the US container market, the Trans-Pacific included. It's something about 25% of the vessels that call the US are of Chinese origin, meaning it was built into a Chinese ship. If you exclude the Chinese operators and you just look at it in terms of the Chinese ship, the fleet of containerized shipping is about 75% non-China, 25% China, which that 25% of Chinese vessels was basically zero 10 to 15 years ago. And so you can see just how quickly it's changed based on the tonnage. What I think, is going to be interesting is if we're in a prolonged tariff environment, are carriers able to redevelop their strings, transition some Chinese ships to some other places, and bring in a lot of the Korean ships, some of the European ships that might still be in the fleet? There might be that opportunity if demand is soft enough to sort of mitigate the charges. That's kind of what we think is going to happen, but it'll be interesting. Really, is going to be the barometer, that the temperature is what happens with global demand, because it's falling, it's dropping. I think there was a stat in the media just today talking about GDP. The expected GDP growth of the US has already been hacked off a little bit. I think it was like 10 or 20%. Things are looking sketchy, and the sketchier they look longer in shipping, these fees may be nothing. They could come out to be nothing if they're able to sort of, if carriers can get off the hook and bring in those other flagged vessels. It'll be very interesting to see how it plays out.
Yeah, and again, if we do get to October and we have these fees coming on and they haven't been able to get them, I mean, it's obviously a double, it's a layer of complexity for the carriers, but I would think it's an even, more difficult one for the BCOs because, we've seen it over the last few years. Two trends. One is that the shipping lines are much more comfortable with adding surcharges onto annual contracts, um, and also, what does that level look like? Every single carrier could have a different rate for every different port pair, and trying to understand the context of how that works. And it just brings the BCOs again towards, how do I split my volume? Outside of the tariff issue with China, how do I split my volume between, I would even say like three different buckets. One is long-term contract.
Mhm.
1 year, maybe if you're a top 100, you're doing 2 or 3 year deals, versus, quarterly 6 month deals might be much more nimble, especially when you consider the timing of October. It's the end of Q3 or going into Q4. And then of course spot as well. Because if you have an annual contract but it's subject to emergency PSS or a surcharge that would be kind of classified as the carriers as emergency here, you're probably going to be hit with these if they do come on in October. So Again, it's just like an unbearable extra level of complexity for the shippers. Again, trying to think about, yes, I've got my annual deal done, but I could have hike in my Red Sea, I could have a change in my BAF, I could have an emergency peak season, I could have whatever this surcharge is going to be. We saw dozens of new surcharges proliferate the industry last year, and this sounds like it could be a whole new category of surcharge again, if these port fees come on.
The one thing, and Graham, you've been in shipping long enough. I know you remember this period. I don't think you had transitioned into software yet, but if you remember VGM, I think it was 2018 or 17, give or take. My years are maybe off a little bit, but generally speaking, VGM flashed up on the screen as, oh, there's some new processes, new fees that are going to be instituted. And I think I remember the day before the institution of the VGM globally, I was having calls with customers at the time, and I was working at an NVO at the time. We couldn't tell them what the cost was going to be. They were at, what's going to cost me tomorrow versus today? And it was a lot of, we'll see and let you know, because there was a lot of confusion. Ultimately, VGM, at least in the United States, I don't know if anyone knows what VGM is anymore, but if you remember correctly, that was a big new cost, it's going to cost more. We don't know what the cost is going to fee. Is going to be 100, 200, 300. Ended up being a lot of nothing. There are VGM fees out there globally, but they're in the, double digits, not triple digits. But it seems like maybe this is just one of those scenarios where it's doom and gloom, and then the day comes and it goes, we'll figure it out, and it's actually not that bad.
Yeah, that's a good way of putting it. And like to me, that just corresponds to more uncertainty. And if you're planning your supply chain, which a lot of big retailers will be planning for Thanksgiving and Christmas cargo around now, and shipping it soon. I mean, how do you plan for this in October? I mean, you can't, you can't disregard it. As of now, it's going into effect in October, per the US Trade Representative. That, of course, could change. It could change up. It could change down. Who knows? But as of right now, as you're planning it, it's something that you've got to think about, and that's again just thinking about the kind of extra layers of complexity. That could be a rate that 10 years ago had 3 surcharges versus now a rate has 9 surcharges. And it could be VGM, it could be an emergency port fee from the port of Savannah, who knows? But it is it is incredibly complex at the moment for the shippers.
It's nothing new in terms of, we don't want any black swan events, sort of like the Ever Given is a black swan, or Red Sea might be a black swan. We don't want any swans, but we're seeing a lot of little ducks, a lot of pigeons in supply chain right now that are keeping us on our toes, and keeping the BCO's budgets in question. That's for sure.
Absolutely. And thank you so much for joining us. I'm Graham Parker, CEO of Chip Angel. We will have more of these market insights. Please feel free to go to shipangel.com. We've got a live chat function. Reach out to us. We're happy to help in any way we can.
Awesome. Thanks, Graham. Thanks for having me. Andrew Bourget, Head of Customer Operations for Ship Angel. Looking forward to see what we talk about next.